Now, how much can you borrow and what is meant by mortgage affordability? Now, mortgage lenders are required by the Financial Conduct Authority to assess whether applicants can afford to repay the loan they wish to take out. Now, to do this, they undertake a mortgage affordability assessment, which considers things like your income, debts, and spending, etc. Now, the consequences of taking out a mortgage you can't afford can be very serious, including losing your home and causing damage to your financial situation and credit record that's difficult to repair. Now, it's because of these consequences that affordability assessments are so rigorous. Now, mortgage affordability is primarily based on your income and outgoings, but other factors can have an indirect impact on the amount you can potentially borrow. Now, how much can you borrow? Now, how much you can borrow will vary depending on the lender. Now, each lender has a different process in how they will assess and calculate your affordability, with some lenders prepared to offer you more than others. Therefore, it's important to seek the services of an advisor who will be able to look at your income, debts and spending to advise on how these will be assessed by each individual lender. Now, if the amount a lender will agree to give you is less than you need, or if the mortgage application declined, an advisor can provide an insight into why this is and what you can do about it. Now, factors that will affect your mortgage affordability. Whilst the largest factor in the mortgage affordability assessment is usually your income, there are other significant factors you should be aware of. Now, things that will be taken into consideration, for example, will be debts. So if you're currently paying off debts, hire purchase agreements, personal loans, credit cards, this can reduce the amount that a mortgage provider is prepared to lend you. In some cases, it may be best to pay these debts off, as it may allow you to be able to borrow more. Spending. Likewise, you may be able to find that you borrow less if you have high monthly outgoings. Lenders want to see how much you spend on bills, food, household essentials, travel, childcare, clothing, leisure, etc. Also your credit history. Now, the better your credit history, the more mortgage lenders and products you'll have access to. So if you have minor issues in your credit report, such as defaults and late payments, you may be offered a lower amount by a lender.